If all these companies are spending $100 billion annually just to cancel each other out in a technological arms race? That's the nightmare scenario for concentrated shareholders like Ackman. You're paying growth stock prices for what might become a commodity business. Now, let's talk about the elephant in the room that makes this even more precarious: the American consumer. Because here's what most investors miss. Google's revenue ultimately depends on businesses buying ads, and businesses only buy ads when consumers have money to spend. If the consumer cracks, the entire advertising market cracks with it. The data here should worry you. According to Deloitte's 2025 holiday survey, 73% of Americans expect prices to increase. Morgan Stanley is forecasting consumer spending growth will slow to 3.7% in 2025, down from stronger previous years. PIMENT's data shows 68% of Americans are living paycheck to paycheck. These aren't opinions. These are measured conditions showing strain in household finances. And Ackman isn't just seeing this in the data. He's seeing it in his portfolio. The same quarter he trimmed Google, he also reduced his Uber stake. Think about that connection. Uber and Google are both proxies for the consumer economy. Uber measures whether people can afford rides. Google measures whether businesses can afford to advertise. When an investor of Ackman's caliber starts trimming both simultaneously, he's making a macro call about where consumer spending is headed. This brings us to perhaps the most interesting twist in the story: Warren Buffett. While Ackman is selling Google, Berkshire Hathaway just disclosed a $4.3 billion stake in Alphabet, making it their 10th largest holding. So, what do you make of two legendary investors taking opposite positions on the same stock? Here's the read. Buffett and Ackman operate on completely different timelines. Buffett is 95 and preparing to hand the company to Greg Abel. He's buying Google as a 30-year holding. The short-term regulatory noise and AI spending concerns that worry Ackman are rounding errors on that timeline. Ackman manages a concentrated hedge fund where performance is measured quarterly. He can't sit through a 30% drawdown while waiting for AI investments to pay off. He needs to protect capital now. This isn't a contradiction. It's two rational investors with different objectives. But here's what both agree on. Big tech is facing an inflection point. Buffett sold 74% of his Apple stake over 2 years while building $320 billion in treasury bills. He's not bullish on technology broadly. He's selectively adding Google while exiting Apple. The message from both: the Magnificent Seven trade is entering a new phase. The buy everything AI mentality is giving way to careful stock selection. The smart money is repositioning before that sorting happens. Let's talk about something most retail investors don't want to hear, but desperately need to understand. The price you pay for a stock matters more than the story you believe about it. And right now, if you own Google, you're paying growth stock prices for what might become a utility stock business model. Here's the math that should keep you up at night. Google is trading at roughly 31 times earnings today. That's a 40% premium above its 12-month average PE ratio of 22. The market is pricing Google as if it's a high-growth technology company on the verge of dominating the AI revolution. But what happens when reality doesn't match that expectation? What happens when investors realize that spending $100 billion annually on infrastructure doesn't automatically translate into proportional revenue growth? The stock gets repriced violently. Think about what Google actually does at its core. It sells advertising. It provides cloud computing services. These are fundamentally utility-like businesses with thin margins and intense competition. Yes, Google has incredible technology and talented engineers, but so does every other Magnificent Seven company. The differentiation is narrowing, and when differentiation narrows, multiples compress. Let me show you what valuation compression looks like in real numbers. If Google's PE ratio drops from today's 31 times earnings down to 20 times, still above the typical utility range of 15 to 18, the stock falls roughly 35%. And that's assuming earnings stay flat. If earnings decline even modestly due to margin compression,